All right, so now we're going to go with and talk a little bit about some business gifts. All right, so business gifts are tangible property, and as long as they're less than $25 a person a year, they are deductible. Incidental gifts, things like gift wrapping, are not included in the cost of the gift, do not apply to the limit. If the value is $4 or left, or a promotional item, they don't cost. So, you go into something and they hand you a pen, and say, here's a Reuben Brown pen, here's a St. Louis Community College something. Those things don't count as anything. So those do not go into the promotional tangible property business gift that you can give away each year. Now, there's a whole bunch of miscellaneous expenses that used to be part of employee expenses: union dues, special clothing, memberships, subscription to trade, licenses that were paid to regulation bodies. Those are no longer there, as they used to be 2% items, miscellaneous items. Those are suspended through 2025. All right, those were part of miscellaneous itemized deductions that are no longer there.
So, like electricians that pay union dues,
Yep,
they can't deduct it, but they can't deduct it from their income at all.
No, nothing. Nope, no union dues. And it did have to be mandatory union dues, but still, no. So, and electricians pay a lot, too. My husband's a Teamster, he pays union dues, and it's not anything like electrician union dues. But they used to be deducted to 2% if you had to have a certain uniform, nurses, electrician, boots, tools, anything like that. Yes, they were all deductible as long as it exceeded 2%, and those are not. Nope, they're gone. And that's
a huge hit.
Oh, it is, and that's where the mileage would go too, for like the dog walker. Okay, educator expenses, teachers that would have unreimbursed expenses in the classroom. This is where it also go. Miscellaneous expenses, that is gone. All right. Now, it had to exceed 2%. So a lot of teachers did have a lot of extra money that they spent in the classroom. If they didn't have other 2% miscellaneous expenses, then it didn't go, because teachers' union dues are voluntary, so they're not deductible. All right, so that didn't go there. However, as you'll see in my next slide, there is a modest relief, and I say that even more than the italics that they're putting up there. Teachers in elementary and post-secondary can deduct up to $250 as long as they work at least 900 hours for their expenses that they have in the classroom. This is a for AGI deduction, okay? Now, it says up to. I honestly, of all my friends that are teachers, do not know one of them that does not spend $250. However, if you do not spend up to $250, you can't deduct $250 just because you're a teacher. So, but it is not college professors, because I will agree that most, though there are some of us that do spend it, most college professors do not spend like they do in the elementary and high school. All right, we don't decorate our classrooms. Okay, I don't buy Kleenex and supply pencils and all that stuff. We have a little bit different support level than they do at the other level. So it is unreimbursed. And now, if I don't have professional development, those type of things, sometimes that, if I needed to, would have been nice, but I can usually get that through education. And I'd just go through it a different way if I needed to. Okay, so QBI. All right, QBI, and this was kind of funny because Marcus is like, I got this credit on my tax return because he was silly. He didn't even know about it. But so this is qualified business income. So QBI is the lesser of either 20% of your qualified business income or 20% of your modified taxable income. Basically meaning you can't get a bigger credit for your QBI than you have taxable income. Okay, so that's why it's one or the other. So this deduction is available for sole proprietorship, partnerships, or S corps. Effectively, a QBI deduction is a deduction from AGI. All right, so it comes after you figure out your AGI, and it's the last deduction before figuring out your taxable income. So it's kind of at the bottom of your half piece of paper, right? This deduction is available whether or not you itemize or do the standard deduction. It has nothing to do with either one of those.
So sometimes you were saying QBI credit?
I said credit, I switched it to deduction. It's a deduction. It is a deduction. It's the last one before you figure out taxable income. All right, where its credits come after that. There are 3 limits on QBI. The first one is the overall limitation based on your modified taxable income. The second is the limit that applies to high income taxpayers. And then the third is the limit that applies to certain types of businesses. The second and third limitation only apply to taxable income before the QBI deduction if it exceeds the following thresholds. 1, 321,400 for married filing jointly. So basically, high income or 120,700 for all other taxpayers. So 2 and 3 only apply if you hit that threshold. Right? Otherwise, those don't matter. And notice 2 says high income taxpayers. So those only come into play then. So the overall limitation, modified taxable income, the overall limitation for this is the QBI may not exceed 20% of the modified taxable income. All right, modified taxable income is your taxable income before the deduction for QBI is reduced by any net capital gain. Now, I will be honest with you, and we have a problem in here, and for those that listen to the recording, I'm putting it on online. There is a problem on here that talks about the fact that there's a business with no employees that has net income on a Schedule C of $205,000, and him and his wife have AGI of $273,000. Right? So they go through, and that's all they have. So it's a very simple problem of just trying to figure out what is their QBI and how you'd go about figuring it out. And I already gave you the answer, and I gave you that answer on purpose so we can kind of look at it together right now. If you look at, they give you the first problem that you want to figure out is what is his QBI? Okay? To figure out his QBI, you take his net income on his Schedule C. So qualified business income is $205,000. You're going to take 20% of that. 20% of that is $41,000. All right? So his QBI is going to be either $41,000 or the lesser of $41,000 or 20% of his modified taxable income. And his modified taxable income, which is on this slide up here, his modified taxable income is going to be taxable income before the QBI reduced by any net capital gain. So his taxable AGI is 273. And then does it say if he had any capital gain? No. But then it says what would be his taxable income? Well, if his AGI is 273 and they had no other income, they claim the standard deduction, how would we figure out his taxable income? What is the standard deduction?
AGI minus 24,400.
You got it. So 273 minus 24,400, and I will give you this answer, times 20% would be, and I gave you the answer, but 49,720. So the QBI is going to be the lesser of 41,000 or 49,720. So the answer would be 41,000. So that is what that plus this slide means. And I think sometimes reading QBI and looking just at this slide, you're kind of like, that's a lot. Didn't record, which would have been helpful if it was recording. So I think looking at this slide and looking at the solution to this problem helps you look at it at the same time. So not just all these words. So when you see the fact that QBI, just take the business income, multiply it by 20%. Then you take the lesser of that times what is their taxable income. All right, in this case, AGI minus, well, standard deduction times 20%. So in this case, it's 41,000. To me, that makes these words a lot more explainable. All right, this goes on to talk about what is qualified business income. So what is a qualified business income? It's defined as ordinary income less any ordinary deductions earned in the place of business. All right, which would make sense. It has to be conducted in the United States. This deduction, I was about ready to call it, James, again, a credit. It's not a credit. The purpose of this deduction is to give this deduction to people who are doing something for small businesses in the United States. It was to stimulate small business growth, the QBI deduction. All right. It also includes distributive shares of those amounts for each partnership or S Corp interest. So it's also including them. Now, the qualified business income does not include certain types of investment income, so you cannot include what we normally would include as dividends, capital gains, interest income. It does not include reasonable compensation or guaranteed payments. For taxpayers with taxable income below, and then it was gone. I think my computer died. So that was nice. All right, so we'll continue. I'll pull it up over here. I can keep talking about QBI. So we don't consider,
Which slide were we on?
we were on slide like 60, maybe 60, right around there. Was that not it?
60 is contributions to retirement
52.
accounts.
What were we on?
52.
52. I was off by 8. Okay. All right. It's trying to reconnect me. It's not going to make it. Luckily, this comes up quick. It's going to be back up in 1 second. I looked at my battery before I came in here. I'm like, oh, that's enough. That will make it. No, it won't. All right, so I think I just switched it back. 52. There we go. Okay. So, I flipped like this one, so 53 maybe. It does not include, as a result, the deduction is available to sole proprietors, independent contractors, owners, S Corps, LLC, and partnerships, which we had mentioned on the first slide. And we talked about the fact that it is restrictions for high income taxpayers. It does, for those that are involved in multiple businesses, you do get this for each business. You just have to do a separate deduction for each one. There are limits. Once a tax income threshold has been reached, the QBI deduction is subject to 2 limits. One is for wage capital investment limitation, and the other one is for specific service businesses. And if a taxpayer has a qualified business loss in 1 year, the deduction is not allowed, and the loss is carried over to the next year to reduce QBI, but you cannot go below 0. So a loss does reduce your QBI deduction. And then wages and capital loss, investment losses does not apply to taxable income before QBI deduction, but taxable income before QBI deduction exceeds $100,000 for married filing jointly. There are some, basically what it's talking about here, if you don't read too much into this, is the fact that if you're paying out a lot of money for wages, it can reduce your deduction. Because if you're paying out a lot of money, it could be have effects depending on what you're doing with your taxable income and how they're looking at your wage. So there's wage limits on that. All right, so does she get a qualified business income? Yes, she does. Her income for tutoring was $39.89 and her freelance was $29.58. Her taxable income was $52,000. So since her taxable income is below the threshold, she has neither the W-2 capital investment limit or the specific wage limit, so she's fine. She takes 20% of each one. She is going to get a deduction of $13.90 because she doesn't exceed the $10,800. So her business income, QBI, is going to be $1,390. All right, so on our contributions to retirement, so they fall into two major categories. All right, so for employees, we usually have one of the two approaches. Most are either exclusions from income for the employees, or ultimately they have an approach for which they followed by a traditional IRA. All right, so you contribute to employee by allowing them to make a deduction for AGI. The maximum this year is $6,000 unless you're over than 50, and then you can contribute $7,000. All right, retirement plans for self-employed taxpayers are different. Now, keep in mind, when I was over here, if you're giving through work, then that is completely different, and you cannot then give an additional $6,000. So if you are donating through work to a retirement plan, all right, you cannot then donate an additional $6,000 outside of that. Sometimes people want to do both, and you can't do that. See, that's one of the most plans are an exclusion from income through contributions to an employee through a pension, or alternatively using the approach by traditional IRA. All right, retirement plans for self-employed are code plans a lot of times, following the deduction approach like traditional IRAs. Amounts contributed on their plan are deductible for AGI, or the other plans are solo, individual 401k, simplified pension plans, or what we call simple plans, savings incentive match plans for employees. Depending on whether they are reimbursed or not, depending on what types of plans they are. So employees, now this is classification of, employee expenses. So whether or not it's accountable or not accountable, or no reimbursement is given. So James, this kind of comes into what your question was about how your dad was given like a certain amount. If expenses are reimbursed by the employee under an accountable plan, all right, neither the reimbursement nor the expenses are reported by the employee. Meaning, if I'm getting reimbursed, your dad was getting reimbursed, then we don't do anything. As an employee, we don't report anything on our income or on our taxes because I'm getting reimbursed by the company. I don't do anything, right? So, in effect, basically, they're treating the expenses as a deduction for AGI, but I'm not doing anything, all right? Because it's not a deduction. It's included, it's basically nothing to me. So it says it's a deduction for AGI, but it's not, okay? Because neither the reimbursement nor the expenses is reported by the employee. The employer is the one taking care of it. If the plan requires the employee to satisfy and account these two things, number one, you have to substantiate the expense. All right? You usually must have some type of adequate accounting to the employee for the expense, a receipt, or using a per diem. I had the per diem. It sounds like your dad had the per diem. At Reuben Brown, we had to have